ಎಲ್ರಿಗೂ ನಮಸ್ಕಾರ. Hearty welcome to Jnanarjane, Empowering Excellence. Friends, we have reached 5th day or the last day of 5 days workshop on accounting standard. Today, we are going to understand accounting standard 22, taxes on income, and accounting standard 29, provisions, contingent liabilities, and contingent assets. To enlighten us on these two accounting standards, we are really fortunate to have CA Aditya Kumar is with us. On behalf of Bangalore branch and on behalf of all the participants here, hearty welcome to CA Aditya Kumar. Hearty welcome, sir. Friends, hearty welcome to each one of you participants. You are the reason for this program. Hearty welcome to each one of you. I'll take a minute of yours to inform you the upcoming programs of your branch. Day after tomorrow, 15th of this month, we are starting 5 days GST workshop for beginners. It is for beginners, 5 days GST workshop. Those who are interested to learn GST and those who wanted to come to GST practice, please register for this program. So it's a 15 hours of study. There is no fees also. It is made it free for our members. I request all of you to register that program. And two more other important programs for this month is on 20th of this month, it is on Tuesday, important amendments for audit 2021. Important amendments for audit 2021 is going to be taken by CA Gurraj Acharya. He is going to enlighten us on all the amendments which need to keep in mind while doing the audit of 2021. I request all of you to register that program. And on 24th of July, we have another very, very interesting program. It is Young Members Mentoring Program. Young Members Mentoring Program. The topic is challenges and opportunities for young CA's firm. Challenges and opportunities for young CA's firm is the topic. It is mainly meant for young members. It is a mentoring program. The speaker on that day is Sanjay Dariwal. CA Sanjay Dariwal is going to impart his knowledge. What are the opportunities? What are the challenges the young CA's firms are going to face in this time? How they can overcome and make a lucrative practice. That is the idea of that program. So I request all of you to take benefit of that program. Even young or old, it is not a matter. So you can take the knowledge from the people who are successful in practice. So I request it is on 24th July, all of you to register that program. And regular study circle meeting, Wednesday, today also is there. Wednesday study circle meeting also is going to be there in this month. With that note, once again, hearty welcome to each one of you. Hearty welcome to our speaker. Over to Divya.
Thank you, Chairman. A very pleasant good evening to all the ladies and gentlemen, all participants, and to our speaker and chairman, sir. To give a brief introduction about our today's speaker, we have CA Aditya Kumar S. with us to present on today's topic. By qualification is BCom from Bangalore University, FCA, Diploma in Information System Audits, certification course he has done in Forensic Accounting and Fraud Detection. He's also done certification in International Financial Reporting, International Auditing Standards and Robotics in Finance, Associate member of ACFE USA. He has also passed Independent Director exams, Corbett 5 Foundation from APMG International. He's partner in the firm since 2007 at Bangalore office. He specializes in accounting standards and other financial reporting aspects. He is a regular speaker in professional forums like Society of Auditors, CA Study Circle, branches of SIRC of ICI, Regional Training Center of CAG of India, Madras University, other institutions. With this very brief introduction, I welcome to you for today's program, sir. Hearty welcome to you once again on behalf of Bangalore branch. Kindly unmute, sir.
Over to you.
Aditya, sir, you have to unmute.
Is it fine? Yes. Thank you, one and all, for this wonderful introduction. And I'm sorry for some technical delay from my side. Mr. Shetty, sir, if you permit me, I will just switch off my video just to conserve the bandwidth so
Okay,
that I can be
as you
more
wish,
audible.
as you wish. No issues.
Okay. Today evening, we are going to, my screen is visible, sir?
It is visible.
Visible.
Okay.
Okay.
Today our accounting standards for non-company entities on Accounting Standard 22 and Accounting Standard 29. These are the two standards that we are going to discuss. The previous speakers in the last 1 week would have already discussed about the background of why we are discussing about the amendments and the applicability of the new standards. So I would not like to get much into it, but just to give a quick brief on that, non-company entities are those entities which are not incorporated or under Companies Act or any other similar regulation, but you have acts like partnership, limited liability partnership, trusts, not-for-profit organizations, those kind of things, including cooperative societies. The question is, how do we ensure that there is accounting standard requirements met in these particular entities? One of the challenges that we normally have in non-company entities is typically these regulations do not prescribe how the books of accounts have to be maintained, unless of course it is from income tax requirements. And many of the non-company entities tend to maintain it under cash system of accounting vis-a-vis accrual system of accounting. Now, the cash system of accounting basically is used by many entities uh, just for the ease of maintaining the records and the lower volume. Whereas the accrual system of accounting is maintained by maybe slightly larger entities like big LLPs for their requirement under reporting requirements. So one of the challenges that we have is how do we apply AS 22 or AS 29 amongst these entities. Now, one thing is very clear for the entities which are maintaining under cash system of accounting. Obviously, the question of making provisions and deferred tax normally would not arise because it is based on receipts and payments. It would be applicable for those entities which are in accrual system of accounting. Having said that, I would always encourage entities to go with accrual system of accounting because it gives more details of the accounts, more updated, and also basically accrues all the expenses. So the financial performance and the position is typically more accurate, I would say, and reflective of the current status. So that is how the accrual system of accounting also helps. Now, in the current regulation on books of accounts, if you would see, as I said, current cash system versus accrual system, many non-company entities may not even have a very structured way of accounting also. That is also one of the things as professionals we need to take care of the clients. After the amendment has come on accounting standard, as you all know, that for level 1 companies, all accounting standards are applicable, and for level 2, 3, and 4 entities as classified by ICI, there are certain exemptions that are given, which has already been discussed in the past. Now, the question I would also want to put it across to the delegates here is, it is not merely accounting standards that have become applicable from this amendment, or the accounting standards would have become diluted. There is also one another factor that we need to consider possibly is the applicability of Ind AS also. Now, as far as the accounting standards are concerned, yes, we know what it is. But when it comes to Ind AS, possibly the question can come, is it not applicable only to the companies? Why would it be applicable to non-company entities? Now, the regulation under Ind AS laws are very clear that where a company, primarily Ind AS is applicable to a company, but if it has investments in subsidiaries, joint ventures, or associates, or maybe its holding entity for that matter, is a non-company entity, such non-company entity are also required to maintain the books of accounts under Ind AS for the purpose of at least consolidation with the entity. Just to give you a feel of this, say you have a partnership firm. Partnership firm definitely need not have to follow Ind AS. It has to follow only the accounting standards issued by ICAI, depending on level 1, 2, 3, or 4. However, if the partners in the firm, or if there is a significant investment by another company for which Ind AS would apply, for the purpose of consolidation, the firm should also have to prepare its accounts for the purpose of consolidation under Ind AS. This is a clarification given by the Institute of Chartered Accountants in ITFG 11, question number 7. What is ITFG? When Ind AS transition is to happen, ICA has now set up a group called as Ind AS Transition Facilitating Group, which has received a lot of queries, and those queries have been answered. So one of the queries, as you are looking onto the screen, is A Limited is a first-time adopter of Ind AS, and it has incorporated a partnership firm with B Limited. Now both Messrs. A and B associates. Now whether Ind AS will be applicable to A and B associates by virtue of the fact that Ind AS is applicable. If you see the highlighted portion at the end of the screen, I have given that Ind AS is not applicable to partnership firm. However, for the purpose of consolidation, the partnership firm will be required to provide financial statement data or the information to A Limited in Ind AS format only. Now, I would like all the members also to get apprised that for these kind of entities, there will be two sets of accounting standards that would be applicable. One is the accounting standard as prescribed by ICA, that is AS1 to AS29. And for the purpose of consolidation, they will definitely have to maintain another set of accounts under Ind AS provisions. So what I'm going to do during this course of presentation is both for AS22 and AS29, I would discuss what is required under accounting standard, as well as what are the key differences that you will have when you will have to prepare the accounts under Ind AS. I will also try to give as many as practical examples or the live examples for the purpose of understanding. Now, if you look at one of the accounts, and all the accounts or reports that I am putting it on the screen is available in the public domain, and therefore it is information available in large, and it is none of our clients or none of the information which is in private domain, which I am not supposed to disclose. All these are available in the websites, hence I am able to disclose it. For example, say this is a company which is a LLP. Typically, LLP is a non-company entity. However, it has prepared its financial statements under Ind AS. And on the right-hand side, you will see the auditors have also given an opinion that these financial statements have been prepared under Ind AS by looking at the words other comprehensive income and statement of cash flows, etc. Having done the audit, they have also given an opinion under, rather in other matters paragraph, they have asserted that because a holding company is required to consolidate, this particular accounts is maintained, or rather is prepared only for the purpose of consolidation and not for the purpose of any other regulatory requirement. That means the company or the LLP here for that example will continue to prepare its accounts under ICA rules for the purpose of filing with tax authorities or any other authority. But for the purpose of consolidation, they would have to prepare another set of accounts under Ind AS. Similar examples of non-company entities you will see is, for example, Lemon Tree. Lemon Tree also has a partnership firm and LLP which gets consolidated with its holding company. Similarly, companies like Infosys, if you see on your right-hand side of the screen, they have certain consolidation, and under that they have given the list of related parties, which include Superannuation Trust, Infosys Foundation. All these trusts together typically they do not belong to company, they are non-company. But for the purpose of consolidation, these entities would necessarily have to prepare the financial statements under Ind AS for consolidation. Just before we go on to AS 22, a typical one more example is on Cadila Healthcare, where again they have consolidated a partnership firm. So what I'm trying to discuss with all of you is business reporting, whether has to be similar, whether it is in partnership firm or company or LLP. That is the beauty under Ind AS. It doesn't look at the substance of the transaction, but rather the form of the transaction, but the substance of the transaction, wherein a business reporting would require the same language. So basically at a consolidated level, they are looking at the results of the entire group, and hence it is essential for these companies or even non-companies in certain cases to prepare and present their financial statements under Ind AS. Now, going on to the next topic, that is our first topic of our discussion, is taxes on income. Let us remember here the title is Accounting for Taxes on Income. It is not accounting for income tax. That is something which we need to understand. And as I already gave in the introduction, that there are differences and multiple things that we do in our accounts cash system versus accrual system, etc. Then we also have ICDS to go with. So you have multiple accounting standards to deal with, which is of course a challenge. Now, accounting standards for taxes on income are applicable to level 1, 2, and 3 entities. However, for level 4, it is applicable only for current tax provisions. That means entities which follow or which fall under level 4, they do not have to worry about deferred tax accounting. They have to worry only about the current tax provisions. Whereas level 1, level 2, and level 3 entities would have to account for current tax as well as deferred tax, and wherever disclosure requirements are to be given, such disclosure requirements also have to be given. Now, here also, where the entity has to maintain two sets of accounts, obviously there will be two different standards, and the application of those standards will also be different. Now, accounting for taxes as income, as I said, it is not restricted to only Income Tax Act. If there is any other tax on the income, even such taxes should also be considered for the purpose of calculating the deferred tax. For example, if you look at this from an annual report of Tata Coffee in the highlighted zone, they have not only calculated deferred tax on income tax under the Act of 1961, but where there was a tax payable called as agricultural income tax. Maybe this law would have been removed by now, but I'm just giving an example where there is any other taxes on income. Such taxes on income should also be considered for the purpose of calculating deferred tax. Another important thing is many firms, LLPs, etc., would also be in the business of, say, tea plantation or coffee plantation or any other agricultural activity, where the rules prescribe that certain amount of income will be automatically exempted. But there will be other portion of income that will be taxable under the Income Tax Act. So in those cases, we'll have to ensure that the accounting for the deferred tax is not only for the income tax, but also for any other taxes that arise on the income of that particular entity. Now, going back to the basics, one, why should we first of all have deferred tax accounting? Why should we not get away with it? The logic here is when I am taking a deduction under the income tax provisions, and I am also postponing certain exemptions. For example, I have made some payments to statutory authorities after the year end or by delated, but the tax authorities would not allow that. They want to ensure that the deduction is given as and when the payments are made, right? This will give rise to differences in the accounting income as well as the taxable income to ensure that there is a match between the benefits that an entity would get at a future date. We create a deferred tax asset. And for those transactions where we have taken the benefit today, but a liability is going to accrue later, we are going to provide for it. This is purely arising on account of differences in the way the tax authorities and the entities would normally treat an expenditure or an income. So the basis of calculation is quite different. Hence, this will lead to certain differences or something called as timing differences. Now, wherever there are differences which would not result in timing differences, we call it as permanent difference, and we do not really get into the accounting for deferred tax or liability for such permanent differences. This table precisely elaborates what I'm trying to say. Now, where the book profit is typically higher than the taxable profit, right? So when the book profit is higher than the taxable profit, what will the entity currently do? It may have to pay lesser tax, but it may be paying more tax in the future, which will create a deferred tax liability. Other way around is also possible, where the entity may be paying more tax now, but it is going to pay less tax in the future. Then it will create a deferred tax asset for it. Deferred tax asset accounting is slightly different from accounting of deferred tax liability, considering that it will be an asset that gets created and in income is also getting accounted. And to be more conservative, we have certain concepts of virtual certainty and other concepts which deal with the deferred tax portion alone, which we are going to deal a bit later. Now, how does this work? Deferred tax is always measured using the tax rates and the tax laws that have been enacted or substantially enacted by the balance sheet date. The reason why we are taking the substantially enacted rates are because on the balance sheet date, yes, you know what is going to be the income tax rates, but what is going to be the deferred tax asset or liability is futuristic. But how futuristic it is, we would at best be able to take the rates that could be applicable in the next financial year. Therefore, the concept here is such benefit or such liability will also be calculated based on the most recent or the substantially enacted tax rates and tax laws as of that particular date. So deferred tax and deferred tax liability should not be measured at the current tax rates, but it should be measured at the tax rates or the laws that is substantially enacted. In India, when it means substantially enacted, it could be like the bill is already there in the parliament, it is being discussed, one of the houses has already passed. The likelihood of reversal of any of those tax provisions will also be pretty low. It is just a matter that the bill gets converted to an act. Second thing is, in India, we know that for different sources of income, we have different types of taxes. You have separate tax for capital gains, then you'll have a separate slab system for individual income, then for corporates, there are different tax rates. So when tax rates apply to different levels of taxable income or even to different entities, the deferred tax assets and liabilities are measured using the average rates. So this is the concept, just to ensure that it is evened out in the financial statement. Deferred tax assets and liabilities should not be discounted to their present value. Typically, it is those assets, financial assets or financial liabilities, where the standard specifically requires for fair valuation or specifically requires it to be discounted. Deferred tax assets and liabilities are not permitted to be discounted to their present value. Therefore, they will have to be accounted at the gross value itself. Whereas in case of certain provisions, we will cover that in AS 29, there are certain cases where it is permitted to discount and account for such provisions. Whereas in deferred tax assets or liabilities, it is not permitted to do the discounting. You will have to account for it as the calculations are. Then, the carrying amount of deferred tax asset should be reviewed at each balance sheet date. An enterprise should write down the carrying amount of deferred tax asset to the extent that it is no longer reasonably certain or virtually certain. Here, there is a very important matter that we need to discuss. Now, look at debtors, look at advances, look at any other loans that we have given. Typically, even for inventory for that matter, wherever there are certain assets which we know that they are not going to be realized, or their recoverability is in doubtful, we normally provide for it. We provide for bad debts, we provide for doubtful debts, we provide for inventory obsolescence. Similarly, we even provide for impairment of assets. Thereby, typically, we take the gross value of the asset minus the provision and give the net value. However, for the purpose of deferred tax, we should not make provision. This is allowed in US GAAP, but not in India. In Indian laws or in Indian GAAP, wherever the deferred tax asset is seemed to be like not recoverable or doubtful, then we have to write down that deferred tax. That means we have to reduce it. When we created deferred tax asset, we would have debited the deferred tax asset account and credited the statement of P&L. When there is a reversal, we will have to do the reverse entry for it and ensure that the deferred tax assets are actually recognized based on either virtual certainty or reasonable certainty, as the case may be. So the question is, when do we use the concept of reasonable certainty and when do we use the concept of virtual certainty? If you look at the income tax provisions, we see that there will be cases where, for example, carry forward losses or unabsorbed depreciation provided under the income tax provisions, where it allows you to carry forward for certain number of years and then offset it with any taxable income thereon. In those cases, the standard requires that you have to be virtually certain before you recognize such benefits. Now, what is the benefit that we are recognizing? The carry forward loss or unabsorbed depreciation in the tax books would further lead to a situation where when I earn income, taxable income, I will have the benefit of setting off the liability against such losses and I will save some money. That benefit is what is going to be accounted as deferred tax asset. Therefore, unless there is a virtual certainty that you are going to make a taxable income, it is not necessary that you make income. It is necessary that you make taxable income in the future. Deferred tax asset should not be recognized. That is the thumb rule. That the rule for recognizing deferred tax asset on the unabsorbed depreciation or carry forward loss is stricter than in other cases where the rule is only on reasonable certainty. That means it is one notch or two notches lower than virtual certainty. These deferred tax assets could arise on account of your differences between the tax liability arising out of computation of income versus income tax profits. Therefore, wherever your taxable income is lesser than your accounting income, obviously there is a liability that you need to recognize. Wherever taxable income is more than the accounting income, it leads to deferred tax asset. And depending on what type of line item it is, you would have to choose whether the test of virtual certainty or reasonable certainty has passed. Based on that, deferred tax asset or liability will typically be accounted for. And I am not getting into the calculation for the reason that we are all aware of how we are going to do the calculation. But just to brief upon, once the accounts are typically finalized and it is closed, in all matters, the entries have all been passed. Then we do the computation of income. When we do the computation of income, we take profit before tax. We add back all those, exceptional cases or expenses that are disallowed under the Income Tax Act, but also adjust such results for any income or any other adjustment allowed under the Income Tax Act. So once that computation is ready, we will actually reconcile line by line, why is my taxable income so much under the tax laws and why is my accounting income so much under the accounting standard rules, based on which the differences you will then classify whether it is going to be a deferred tax asset or a deferred tax liability. That is how typically we have been doing right now. Now, accounting, how do we account for these deferred taxes on income? If you look into the P&L account, the P&L account after the net profit has something called as taxes. That tax has three line items. One is the current tax, one is the deferred tax, and the third one is tax related to previous years or prior years. Now, current tax is the line item wherein the company, but the entity is going to provide for income tax for the income earned in the current year. That is why it is current tax. Whereas the deferred tax line item is to route your deferred tax asset and deferred tax liability accounting under a single line item, which will further be disclosed in the notes to accounts later. Now, as we all know, that the returns will be filed only after the year end is over, tax audit is all done, right? But the assessment may take some more time. As and when the assessment gets completed, either the entity would have paid more tax for which they are eligible for a refund, or the entity would have paid lesser tax for which they would have to pay additional money as the tax. Now, wherever such adjustments are required, it is called as tax relating to prior years. Now, Mr. Shetty, is my screen visible? All of a sudden, it just vanished.
It is not visible.
I don't know what happened. Anyway.
It is now there. It has come back now.
I don't know. Something is wrong.
Okay.
So, accounting for taxes on income depends on whether it's current tax, deferred tax, or tax relating to previous years. Whenever a company pays advance tax and also has a tax provision, that information is kept over a period of time. As and when the assessment gets completed, we would be adjusting the advance taxes against the provision, and the net figure will then be taken into P&L account as tax relating to earlier years or previous years. If there is any other penalty, etc., of course, that will be disclosed separately. This is how the presentation of the deferred tax and deferred current tax will take place. Now, whenever an entity has both deferred tax asset and a deferred tax liability, if the tax provisions permit it to be set off, you can always set it off and show the net item in the balance sheet as net deferred tax asset, or deferred tax asset in bracket net, or deferred tax liability in bracket net. Now, why does the standard say if the tax provisions permit? There could be circumstances where the income tax law specifically mention that you cannot adjust payment against the tax of particular item with another item, or possibly you may have entities or you may have businesses outside India where there could be deferred tax situation there and deferred tax liability situation here. When you consolidate your accounts, you cannot consolidate these two because they cannot be offset under the same jurisdiction. Therefore, in those circumstances, DTA and DTL will be shown separately. Otherwise, it is always shown on a net basis. Now, first time when an entity is applying deferred tax. What should the entity do? All these years, for whatever reason, it was not applicable, or rather it was not accounted for. So whenever an entity for the first time accounts for under AS 22, the standard is very clear that it should be first hitting the revenue reserves. There is one question here. I'll take all the questions at the end. On the first occasion that the taxes on income are accounted in accordance with this standard, the enterprise, that is the entity here, in its financial statement should account for this deferred tax balance in the revenue reserves. Only then it can account. What could be the situations? For example, a company is taking actuarial valuation accounting for the first time now, right? It has not yet taken, either it's an error in accounting or they have not complied with the standards or whatever could be the reason. When they're doing it for the first time, then any difference arising out of the transaction should be accounted in the reserves as far as the accounting for taxes on income are concerned. Now, let us go to the scenarios. Now, typically, as I mentioned, that there are certain scenarios which are different under Ind AS 12 when compared to AS 22. Under AS 22, you are always focused on the P&L account. That is the effect of differences between taxable income and accounting income. So your all focus is on the balance on the P&L account approach. Whereas under Ind AS 12, for those entities which may have to prepare the financials, at least for the purpose of consolidation, then the balance sheet approach is used. What is balance sheet approach? Typically, we prepare a balance sheet based on the tax laws. You may ask, where is the balance sheet format given for under the tax laws or whatever? With the entries that have been passed, if the depreciation, for example, section 32 has certain depreciation, what if I had calculated the depreciation on my assets based on those laws? What if I had not accounted for those expenses which are disallowed now? What would be my net worth position? What would be my assets and liabilities? Depending on that such movement of assets and liabilities, you would then recognize deferred tax asset or deferred tax liability. Typically, one leg of the P&L account is always there in the balance sheet, but there could be certain items in the balance sheet which would not have been recognized in AS 22. For example, in the same slide at the end, I have given something like, say, revaluation of assets or possibly goodwill on acquisition, etc. So these are certain matters which would require attention when you are preparing the deferred tax calculation under Ind AS 12, where the benchmarking is quite different. In AS 22, we always talk about timing differences and permanent differences, whereas in Ind AS 12, we talk about temporary differences and whether these temporary differences are going to be taxable or are going to be deductible. That means, will this difference arising out of the difference in the balance sheet, will it get taxed in the future or will it get deducted in the future? Such differences are only considered for deferred tax accounting. Of course, permanent differences are not covered because anyway it is not going to be recognized either way, both under AS 22 or under Ind AS 12. Now, the very, very important aspect here is under AS 22, we have the concept of reasonable certainty. We have the concept of virtual certainty in case of recognizing DTA on unabsorbed depreciation and carry forward losses. Whereas in case of Ind AS 12, it is only to the extent of probability of taxable profits. The concept of virtual certainty is not there in Ind AS 12, thereby sort of eliminating the confusion as to whether something is reasonably certain or whether something is virtually certain. So under Ind AS 12, it is a bit easier, I would say, in our experience at least, to conclude whether there is a probability of taxable profits in the future period arising out of these transactions. Therefore, there will be fundamental differences between AS 22 and Ind AS 12. Further, when it comes to the disclosures, there are a lot of disclosures under Ind AS 12 which is not there in AS 22. Now let us cover what are the disclosure requirements. Under AS 22, the disclosure requirements would be: you give the computation or rather components of deferred tax asset and deferred tax liability for the previous year and current year. Then you take the net of it and then carrying it to the balance sheet. Now, typically that would all be the disclosure with relation to deferred tax asset or liability. And if at all the company has carry forward loss and unabsorbed depreciation, then the company would have to disclose what is that virtual certainty feature that they had to ensure that the deferred tax asset is recognized. So it is very important to disclose wherever we are creating deferred tax asset on carry forward losses and unabsorbed depreciation, what is the test has been done to conclude that there is virtual certainty that there will be taxable income at least in the foreseeable future which would offset these losses. Under Ind AS 12, you will be surprised to know that there are reconciliations and reconciliations that are required. In AS 22, we nowhere disclose what is my accounting income versus taxable income and why there is a change. Here, there is a change required in Ind AS 12. Typically, under AS 22, if you take the current tax, divide it by the profit, it would definitely not match with the tax rates because that accounting income would have been added or subtracted or adjusted with various tax provisions, and after that the tax rate or the taxable income, and thereafter the tax would have been arrived at. But in Ind AS 12, you will have to reconcile: this is my accounting profit, this is my taxable profit, and why there is a difference between the two. I will also show some example as to how certain companies have done. The option given to the companies or rather entities which are required under Ind AS 12 are either you reconcile the effective tax rates or you reconcile taxable income versus books. One of that information should be available. Now, what is effective tax rate? Effective tax rate is the ultimate tax that an entity is paying when compared to its accounting profit. That is the effective tax rates. The third disclosure would be any reasons why the deferred tax asset has not been recognized. Say for some reason the entity has chosen not to recognize any deferred tax asset. For example, the virtual certainty test would not have passed or reasonable certainty test would not have passed. In those cases, the entity is required to disclose as to why a deferred tax asset has not been recognized, which was not there in AS 22. Similarly, when the deferred tax asset has been created, what is the possible year of utilization? In how many years or period will this asset get nullified or exhausted should also be disclosed. Of course, there will be a lot of judgments, management estimates, auditors' discussions, and there are cases where it is pretty gray. In those cases, there are certain judgment calls either the management or the auditor would have taken in this regard. Coming back to the fundamentals, as I said, in case of income tax under AS 22, the current tax portion or the deferred tax portion would have been accounted only after the net profit after taxes. That is the only place where you would have found your tax details. Whereas in Ind AS 12 or Ind AS framework, this tax would be found in three different places. One, in the profit and loss. Second, in the other comprehensive income. And third, in other equity. Now, just to touch upon what are the other two things that we are talking about. Under Ind AS, there are certain transactions which are not routed through P&L account, but which are routed through other comprehensive income, which is sort of an extension to P&L account, and ultimately the net profit in the P&L account and the result on other comprehensive income will flow back to the reserves and surplus, which we call it as other equity. Though the results are the same, the presentation and the disclosures are different under Ind AS. In those cases, you will find the tax is not only accounted in the P&L account, but is also accounted in other comprehensive income. What is an example I can give? In other comprehensive income, we typically account for actuarial gains or losses arising on defined benefit obligations. Now, these defined benefit obligations are like gratuity, for example. Now, typically what used to happen when you apply your AS 15, any changes in the actuarial valuation, you would have debited employee benefits. That's over. That's where the story closes. Whereas under Ind AS 12, such provisions are split into three parts. Those relating to current cost is included in P&L account, and the rest of them are included in other comprehensive income. So if you see any of the annual reports of listed entities, you will see in other comprehensive income items that will not be charged back to P&L account, and the first one you will see is defined benefit obligations and actuarial gains. Now, why are we talking about actuarial gains? Why are we talking about employee benefits here? Let me make it a little bit more simpler. Now, when this particular expense has been debited to P&L account, similarly, there could be other expenses or income also. This will have tax implications. That means when I've debited my salary cost, obviously it is allowed under the income tax provisions. But what is the impact of debit to the P&L account when you over the tax rate is something was not being captured under AS 22. Now under Ind AS 12, what we need to do is what is this impact on the P&L account or impact on the other comprehensive income should be taken separately and shown separately. That is the reason the tax will happen in three different places. One, all those taxes, whether it is current tax or deferred tax, all those taxes which are relating to the items in the P&L account will be accounted in the P&L account only. All those taxes which are relating to the transactions in the other comprehensive income will be accounted in other comprehensive income only. Third part, if at all there are any transactions which are directly accounted in other equity or reserves, income tax application and its impact is also accounted in other equity directly. It will not be routed through P&L account. Therefore, the way the income tax itself gets accounted is completely different under Ind AS 12. How do we know what is the total income tax provision? Therefore, in the notes to accounts, these companies or entities would have to disclose my current tax in P&L account is so much, in OCI it is so much, in statement of changes in equity it is so much, and finally what is the total tax that the entity is liable to pay. So this is one big disclosure that would be required. Then, wherever there are changes, such changes in the tax rates will also have to be substantiated. So the disclosure requirements under AS 22 is way less than what is the disclosure requirements under Ind AS 12. I will also take you through one of the companies or the listed companies, how they have disclosed it. When it comes to revaluation of assets, since we use P&L account approach, it is not applicable in AS 22, whereas it is covered under the Ind AS 12. Similarly, goodwill, for example, goodwill on business combinations are not covered under AS 22, whereas it is covered under Ind AS 12. Very interestingly, you will see that in the last item, I have mentioned something that on consolidated financial statements. Why am I talking about this? In many jurisdictions or geographies, the tax department is currently accepting their income tax returns and income tax computation based on the group, that is the consolidated results. That means if there is an entity, it has a couple of subsidiaries, joint venture, associates, etc., the entire group will be filing only one income tax return and not independent legal entities. Therefore, for those kind of entities and for those kind of geographies, the deferred tax asset and liability calculation will be done at the consolidated balance sheet level and not at the independent P&L account level. However, in India, this is more of an academic interest. It is not applicable because India, we do not have the concept of filing consolidated return. Every legal entity has to file independent return. Even the tax assessment and the tax processing is done at individual legal entity level, whereas in other jurisdictions it is done at the consolidated level. Any net tax payment or tax receipt has to be taken care by the parent entity. That is a provision in other countries. We don't know whether that such provisions will ever come here at all. Then there is this concept of virtual certainty I've already explained. There are certain tax holidays and there are certain specific to India. There is DTA on capital gains, etc., which is covered under AS 22, which is specifically not covered under Ind AS 12. So somebody might ask, why is it not covered under Ind AS 12? Let us all remember that the entire Ind AS structure is borrowed or is carved out from International Financial Reporting Standards. India may have Income Tax Act, 10A provisions, 10B provisions, 80IA provisions, and so many other provisions. But we can't expect, or rather not presume, that all other countries will also have such tax laws and tax holidays. Therefore, what IFRS does is, wherever it is specific to a particular law, it does not cover, it only gives you a framework, it only gives you a principle on which you may have to account for it. Having said that, the Institute of Chartered Accountants have brought in a lot of guidance notes, ITFG, clarifications, especially on accounting for entities where they have claimed 80IA deduction or 10A or 10B income. There are specific illustrations given by the CA Institute which can be followed. So this is broadly what covers under Ind AS 12. Now, when we are accounting for this, obviously you need certain disclosures, and I thought I can share some of these disclosures with all of you. Now, on the left hand side, you would see the computation. I'm not able to, enlarge my screen. I'm sorry about it, but this presentation will be shared with everybody. You will see that profit before tax is reconciled with income tax expense. This is from TCS. So they have reconciled what is the profit before tax, what is the statutory tax rate. For them, the statutory tax rate is 34.94%. So what they have done, the profit before tax is 43,700 crores. 43,700 crores into 34.94%, they have arrived at 15,292, which is the expected income tax expense. That means if I apply my tax rate directly over my profit before tax, this would have been my income tax. But what is that the provision made? The provision for current tax is 11,198 crores. So where is the difference between 15,000 and 11,198? Such differences are reconciled as tax holidays 4,708, income exempt from tax 325, undistributed earnings in branches and subsidiaries 843, income tax on differential rates 843, 13 and 843, tax pertaining to prior years minus 180, and all others are given as net figure as others. When you write others, whether it is in this schedule or anywhere else in the financial statement, such others will also have to be mentioned as to what is that item, which is what they have explained. The explanation clearly indicates that they have certain business in special economic zones and there were certain exemptions on export based on which the company has earned certain benefits. such benefits in income tax will have to be reconciled and disclosed both for the current year as well as the previous year. Now, if at all there was a change in the effective tax rate, such changes in the tax rate should also have been disclosed. So this is the first part of disclosure. The second part of disclosure you would see is they have reconciled the opening deferred tax with the closing deferred tax. So the opening balance is given. Then what is the additional deferred tax asset or liability taken in the P&L account is given. Then any deferred tax or liability in other comprehensive income is given. Any further adjustments, and ultimately closing balance is arrived. This is what I was trying to say, that when you reconcile, since your tax is spread out in different places, you need to add up and show that where is this closing balance arrived from. So even for the deferred tax asset, the amounts will be reconciled as how much is from depreciation, how much is from hedging activity, and whatever are the transactions that needs to be reconciled, based on which you arrive at the closing balance, and such closing balance needs to be disclosed. Now, if you would also see, there are cases where they have shown how much is the unabsorbed business losses, and by when this unabsorbed business loss is going to be extinguished. In this particular case, they say that unabsorbed business losses will be set off in the future in 2022, 23, 24, going up to 2026. So unrecognized deferred tax assets, they are here in this case are typically the business losses and tax credit entitlements which do not qualify recognition as per the accounting standard. As far as the companies are concerned, I would just like to add one more thing. Wherever it is MAT credit available, the MAT is treated as deferred tax asset under Ind AS. It may not be so in AS 22 scenario, but under Ind AS, it is treated as deferred tax asset. Having said that, if you look at the right side of your screen, they have also given what are the different contingencies, what could be the risk in recognizing certain deferred tax asset. Such disclosures are also essential for the reader of the financial statement to understand why such deferred tax asset has been created. This is again the explanation required to evidence or to prove that there is a virtual certainty arising out of the transactions, and hence therefore they have accounted for this deferred tax asset. Such a beautiful note is definitely required to substantiate the concept of virtual certainty. Now, after this note, this is how the notes under Ind AS 12 happens. Now, if I look at the FRRB, that is the Financial Reporting Review Board of ICAI, they have reviewed both Accounting Standard 22, as well as Ind AS 12, and they have come out with a publication which deals with what are the common mistakes that the entities do in the financial statements. It is a very good read, and I encourage everybody to read that. It's a free publication available on the Institute website, or it can be bought in a hard copy as well. So some of the mistakes that FRRB has identified in when they review the financial statements. Just for some members who may not be knowing exactly what is FRRB, I'm sure most of them will know, but just in case somebody doesn't know about it, FRRB is Financial Reporting Review Board instituted by ICAI. It's a part of the ICAI. Now, this is a committee or this is a board which will pick up the financial statements available right in that domain, or the institute will give them to review it. Now, this review is done by chartered accountants having a lot of years of experience. They review the financial statements without having access either to the auditor or to the company or to the entity. They have to do an independent review of the financial statements with respect to the accounting policies being used, compliance with the accounting standards, disclosure requirements, the quality of presentation, etc. If there are any issues arising out of the review, depending on the severity of the review, it will be dealt with accordingly. If there are significant misstatements, significant errors in the financial statements, it is also possible it can turn out to be a disciplinary issue also. Whereas if it is a minor ones, they would intimate the company or they would intimate the auditor depending on whether the issue is in the audit report or the issue is in the financial statement, to ensure that this gets rectified in the forthcoming financial statements or the next period. So this is the background of FRRB. Similarly, even you also have the reviews from the peer reviews and the quality review board. All of them are available on different websites, which would help us to understand how the entities are literally accounting and what are the common mistakes. And I'm sure by learning from others' mistakes, we become more wise. That's the background. In many entities, the FRRB indicates that the breakup of DTA/DTL has not been given, which is a requirement under the accounting standard. Whether it is AS 22 or Ind AS 12, the breakup of DTA and DTL is absolutely essential, because only then the stakeholders or the readers of the financial statements would know what is this amount considered as an asset, what is its value, and what is the recoverability chances of these assets going in future. Hence, that breakup is essential. Similarly, the second comment that they have made is where they have to mention others, they have not given the explanation what those others are. Typically, you will find FRRB commenting on this others word not only in deferred tax asset or liability, but they would also be commenting this in, say, in schedule of creditors or trade payables, schedule of loans and advances, provisions, where a lot of entities write others, but they don't explain what those others are. So my request or my suggestion is to use the word others very sparingly, and if at all it is being used, to at least generally explain what does it constitute. There are companies or entities I would use saying that the deferred tax liability is classified under reserves and surplus. Wrong. That's a separate line item that is prescribed by ICI. That is where the deferred tax liability or asset has to be disclosed. You cannot disclose in any other manner or in any other fashion. There is another entity which has shown income tax as an appropriation of profit. It is not an appropriation of profit, it's a charge against the profit, and the charge should be debited to the profit and loss. That is another error. Then, not setting off DTA or DTL when it is required. Again, if the DTA and DTL has to be set off, I presume the local regulations and the tax regulations permit it to be offset. If it permits to be offset, then obviously the DTA and DTL should be netted off, and the net figure only should be carried to the financial statements, that is the balance sheet. And the breakup of that is given in the notes to accounts. Having said that, do I have a choice to take DTA separately and DTL separately? No, I don't have such choice, because it would rather convey that these asset and liabilities are not offsetting or not permissible to be offset, which is misleading the stakeholders. DTL not recognized on special reserve created under section 3510. Like this, they have also given a lot of examples where there are cases under 43B, there are cases of unabsorbed depreciation. They've just not, the entity has just not created a deferred tax asset or a deferred tax liability. And the worst thing is, even in the notes to accounts, nothing is mentioned about why such accounting has not been done. So this is very, very important for us to understand. Then nature of evidence for creating DTA is not provided. It is not essential to just to mention unabsorbed depreciation / carry forward loss. One has to write a commentary as to how does the company or how does the entity have a virtual certainty of ensuring that there will be benefit arriving in the future for which DTA has been calculated. then there is no bifurcation between current tax and tax relating to earlier years. So the company entity would have received a tax notice which would have been accepted and the tax would have been paid. But that tax would have been relating to earlier years. It is for the entity to show such payments as a separate line item in the P&L account as current tax, deferred tax, and tax relating to earlier years, because it's the cost for that particular period. And if the cost for that particular period includes tax relating to earlier years, it gives a misleading figure. Your effective tax rate calculations will be wrong. Once it is wrong, your DTA, DTL could also get affected. Then provision for tax is estimated based on income tax loss and advice received. It is the management's responsibility ultimately to prepare the financial statements and then take a call on certain provisions. They cannot be pushing it that we have received certain advice, based on such advice we would have made a provision. On that note, I just have to take you back to one of the slides where I have mentioned about IFRIC 23. Now IFRIC 23 is no longer there because Ind AS 12 has been amended. IFRIC is nothing but International Financial Reporting Interpretation. Now, certain provisions of tax that we create, when we prepare that schedule, we estimate that what is the likelihood of these claims or this demand to be fructified, right? We would have got a litigation. Now, what is the possibility that this litigation could either turn out to be like a liability to the company or could turn out to be a refund for the company? Therefore, it is essential that under Ind AS 12, there is a separate requirement under IFRIC 23 or under the amendment to Ind AS 12 as to how these calculations are provided for, and that's a separate disclosure also required for it. So FRRB comments. Then including gratuity deduction under section 43B. These are all again tax interpretations. 43B does not cover covers only statutory dues or statutory duties or the specifically required under the statutes to be paid. This is more of an income tax issue. But having said that, when the DTA or DTL has been presented, they have classified it in an incorrect manner. Now, these are some of the common views or the common mistakes that entities have done in their financial statements. There are actually still more, but I've restricted considering the availability of time and the applicability of some of these provisions to non-company entities as well. You will also have similar issues on international taxation and recognitions, etc., which I would encourage you to go through the FRRB literature to have more information on this. Sir, can I take up some questions on AS 22 till now?
Yes, there are no questions being asked as of now.
There were certain question and answer. Nothing? No questions asked?
No,
but
sir.
I did
Please check your chat box if anything has been asked directly to you, sir.
I don't see anything here. But I did see some questions popping up.
No, there are questions in the chat box. Chat box, there are questions. Divya, please read out.
1 second.
Yes. Chat.
One question is there.
Not one. There are 2, 3.
I can see only one question.
2 questions. Can we offset DTA, DTL if the tax loss permit? Yes, you can. For example, the typical is, say, for example, you have created what do you call, you have your provisions in income tax, how to set off business loss against capital gains or other sources of income, things like that, where the tax laws typically permit you to offset it. Yes, you can offset. Otherwise, you cannot offset it. In situation where there is no variation in the amount of timing difference, but there is only reduction in the income tax rate. Should the DTA DTL be adjusted to give effect to such reduction? What other disclosures need to be made in a situation where there is no variation in the amount? So you are saying the timing difference is there, but only the tax rates have changed. Yes, I think we should do that, because we are only taking the tax rates which are substantially enacted when preparing these financial statements. Where there is a substantial enactment is there and it has reduced the tax rate, you will have to take cognizance of such tax rates and then account for such tax, DTA or DTL accordingly. There's one more question that is coming up. It's the same question. Please give few examples for those events which fall under can offset DTA DTL if the tax laws permit. Again, I'm repeating the same thing. It again depends on your provisions in income tax which permit you to either offset within the heads of income or take it to the next financial year and offset. If such offsets are permitted, then you can take DTA, DTL. If it does not permit, then you cannot take the deferred tax asset or liability. You have to keep it separately. So that's one thing. So moving on to the next topic, we have a larger topic, the provisions, contingent liabilities and contingent assets. Now, there are certain scope ins and scope outs. As far as the level 1 is concerned, AS 29 is applicable, whereas for level 2, 3 and 4, there is no disclosure requirement or reconciliation of provisions, descriptions, assumptions. Disclosures have been diluted, accounting is required. See, any accounting standards will have 4 pillars: recognition, measurement, presentation, disclosure. As far as AS 29, for level 2, 3 and 4, recognition and measurement, yes. Presentation, yes. Disclosure, not required. So that is how they have structured all the accounting standards. Now, as far as AS 29 is concerned, it is accounting for provisions and contingent liabilities and how to deal with contingent assets, except for certain few cases. Having said that, under AS 29, there are 3 pillars that we talk about: provisions, contingent liabilities, and contingent assets. We will go each topic line by line. What is a provision? A provision is a liability which can be measured only by a substantial degree of estimation. Especially this is very important when we are following accrual system of accounting, because certain expenses get accrued as on the date of reporting. When such expenses get accrued, we may not be having the exact amount of that particular amount. We may have to make an estimate. Typically, for example, I have purchased goods. The goods are received, but I have yet to inward it. But I know what is the value of the goods. I have an invoice for it. Therefore, I can still account for it as a liability. But when it comes to certain expenses or certain accounting, like gratuity, compensated absence, warranty, income tax, litigation provisions, these are all only estimates that are being made. Whether it is made by an actuary or external valuer or internally calculated, all these are just an estimates. Income tax is also an estimate, because our understanding of the law, our interpretation of the law could be much different from the tax authorities. Therefore, it is just a provision that is always created for income tax. Similarly, for litigations also, wherever we do not know what could be the outcome, then we only make a provision. But the big difference here one should appreciate is the difference between a present obligation and a possible obligation. Now, a present obligation means, say we are preparing the financial statements as of 31st March. A present obligation is what we need to pay today, or we are supposed to pay today, and we have an evidence relating to that. And such evidence indicates that more likely than not, that means the chances of this not being honored is very, very low. It is called as present obligation. That means where the fact that we have acknowledged the debt and it is going to be paid, very, very remote case of not being paid. Whereas in a possible obligation is again an obligation. Again, it is based on a calculation, but we really don't know whether this is going to be paid or not to be paid, or how much will be paid. So we have three types. One is present obligation, one is possible obligation, one is even remote. We will not even consider that in any of these accounting aspects, because we know very well that it is not going to impact the financial statements or the position. So a present obligation and a possible obligation needs to be considered at every stage in Accounting Standard 29. What is a liability? What is the difference between a provision and a liability? Something which we definitely need to look at it. Many times we look in the financial statement, what has to go to provision would have come to liability, and what is a liability would have gone to provision. Okay, the total of the liabilities or the balance sheet may still be the same, but the classification and disclosures would be incorrect. In case of a liability, it is a present obligation of the enterprise arising from the past events, right? The settlement of which is expected in an outflow from an enterprises of resources embodying economic benefits. This sounds to be very complicated definition. It is not so. The standard simply says that you have had certain transactions in the past, or you are having certain transactions now for which you are obligated to pay, right? But you are only deferring the payment. It is a cash flow issue. Since it's accrual system of accounting, you will have to recognize that expense or that liability now. That is the first concept. What is the second part of the sentence, which is expected to result in outflow of resources? The outflow of resources could be that liability is being settled by cash, or that liability is settled by issue of shares or debentures, or that liability is being settled in any other manner wherein the resources of the company will have to go. In those cases, a liability needs to be created. Now, when they say what is a present obligation, what do you mean by obligation? It is an obligation. It could be a contractual obligation, or it could be a legal, or what do you call it, as a statutory obligation. Wherever there is a terms of contract, for example, employees, salary has to be paid, that is given in the employee contract. Taxes have to be paid, that is a statutory requirement, right? You have other contractual obligations like rentals, AMC, so on and so forth. All these obligations are either contractual / legal in nature or in statutory in nature. All such obligations have to be accounted. But when they get accounted, it's only a question of whether it's a liability or whether it is a provision. Typically, amount payable to employees like salary, bonus, it's all determined. We know what is the amount that is going to be paid. The amount is frozen. Such amounts shall not be classified as provision. That amount shall be classified as liability only, not as a provision. Provision means where you need certain calculations, assumptions, input data, certain management judgments are involved in it. Now, as far as contingent liability and contingent assets are concerned, this is the second part of it. A contingent liability is a possible obligation. Now, what is possible obligation? It's an obligation based on the evidence available. Its existence at the balance sheet is considered not probable. We don't know whether it will happen or whether it will not happen. Now, such liabilities are not recognized in the books. We only disclose it as contingent liability. A possible obligation that arises from past events and existence of which will be confirmed only by occurrence or non-occurrence of one or certain future events, which is beyond the control of the entity, is contingent liability. That means these are the cases where, for example, there's a litigation. Typically, I'll take a case of litigation, right? Or even a case of a tax dispute. You do not know whether it is going to be in your favor or it is going to be in the favor of the other party or the department. Such cases, we only disclose that amount as a contingent liability, which may or may have to be paid in the future. But when such decisions are happening, it is beyond the control of the entity. Or it's a present obligation that arises from past events, but it is not recognized. It is not recognized because either you're not going to pay for it now to settle it, or a reliable estimate cannot be made. When a reliable estimate cannot be made, you can only disclose it as contingent liability, but you will also have to disclose as to why this cannot be quantified. That is important. As far as provisions are concerned, we will have to account for it, and there are certain disclosure requirements. Whereas in contingent liability, we will not account it. It is only a disclosure requirement. Contingent assets is opposite to contingent liability. In contingent liability, you may end up paying money. You end up losing certain economic resources. That is why it's a liability. Whereas in a contingent asset, you might be in a position to gain certain money or gain certain economic benefits. Such contingent assets arising from the past events for which you may end up getting something is neither recognized, neither disclosed under AS 29. It is disclosed under Ind AS 37, but not under AS 29. So this is the concept of what is a provision, what is a contingent liability, and what is a contingent asset. Many entities would try to say, when you look at the financial statements or report, you'll find that certain things genuinely are provisions but are sitting in contingent liabilities. This is nothing but misstating the financial statement. This is nothing but misstating the financial statements. Provisions and contingent liabilities are completely two different things, and they will have to be accounted based on the nature of the transaction, the nature of the obligation. To make certain, the decision making simple, I happen to get one flow chart which is given by Mr. B.P. Rao and another, giant in the profession, right? I happen to take I have also given from the website where I have taken this. So he has wonderfully put this entire chapter in a flow chart. He classifies this into whether the obligation is a probable obligation, possible obligation, or remote. Now, what is possible and probable, we have already discussed. So he says, if there is a present obligation, right, arising out of an obligating event, some event has happened. For example, I have bought certain asset. Event has happened. There is an obligation for me to pay. Yes. Is there an outflow? Yes, because I have to pay money. Do I know how much money I have to pay? Yes. Then I have to make a provision or create a liability for it. Wherever I have procured goods, taken services, taken certain transactions which I need to make the payment in the future, I know how much amount I need to make in the future reasonably well, then I have to make an account for it. Having said that, in the similar way, if I do not know whether I will have to make this payment, whether it is remote, I will only first disclose it. It is not remote, but I know I'm going to pay, but I don't know how much I have to pay. Then it will be a contingent liability. That means I have procured certain things, but I'm not sure how much I'm going to pay and what will be the impact. Then I'm going to show it as only as a contingent liability. But if there is no obligation to pay and the chances of occurring this transaction is also very remote, just don't do anything. We are not going to do anything in the financial statements relating to that. So this is a wonderful chart that Mr. B.P. Rao in one of the seminars he had given, how to classify certain things, or whether they have to make a provision, whether they have to disclose as a contingent liability, or they have to do nothing. Based on this chart, your accounting also needs to be carried out. Now, what are different things that we also need to understand here is, as far as the contingent liabilities are concerned, We are only going to disclose it. Recognition is not there. We are not going to put it in the P&L account or in the balance sheet as a liability, right? And as far as the contingent asset is concerned, we are only going to disclose certain contingent assets only under Ind AS scenario, not under the current AS 29 scenario. By the way, AS 29 was also amended a couple of years back, wherein certain new clauses were brought in or certain existing practices was revisited. Now, there are two examples that I can give. There is this provision for decommissioning liabilities or decommissioning provision. Now, what is this provision for decommissioning liability or decommissioning provision? Say, for example, you have an entity has taken a property on rent, and one of the clauses in the rental agreement indicates that when they vacate this property, they will have to give it in a clean broom condition. That means whatever additions you have made, you will have to remove it. Whatever fixtures you have made, you will have to remove it. You will have to give back that property to the landlord in the same manner as it was given to you. In that case, the accounting standard 29 now requires you to recognize certain things as decommissioning liability, wherein you will have to estimate what is going to be the cost of dismantling this entire setup, maybe 7 years down the line or 8 years down the line, as the case may be. Discount that estimate to today's value and provide for it. Suppose if you are going to incur an expenditure of say 1 lakh, the 6 years down the line, then such 1 lakh needs to be present value to today's money. Say today's money, I'm just taking an example, it is 50,000 and account for it. Year on year, this provision then will have to be restated. How will this provision be restated? We will be debiting interest cost and crediting the provision. At the rate at which it was discounted, we will use the same rate to increase such provisions as well. That is one of the example. Second example I can give is entities which are in exploring or exploiting the natural resources like mining, etc., where there are stringent requirements to bring back that particular location to the same condition in which they are given. There will be significant cost incurred for that. So these entities then have to estimate what is the possible cost of this restoration and provide for it upfront in the first year itself. That is called as decommissioning cost or the decommissioning provision. The second significant amendment that was made, of course, it will be applicable to companies and not for non-companies, but just to give an example, is accounting for dividend. Earlier, there was a provision that was created for dividend. Now, under AS 29, such provision for dividend is not permitted. You will have to provide for dividend only when it is taken in the board and it is approved. Only then such provision can be made. So these were a couple of changes. Now, what are the requirements of disclosures of provisions or contingent liabilities and contingent assets? Now, you will have to start the disclosures from the opening balance of provision. Now, whatever is the opening balance of the provision, you will have to then reconcile it to the closing balance of the provision. Typically, you would see this in actuarial valuation reports where the gratuity valuation or the leave encashment calculation, the actuary would have given what is the defined benefit obligation at the beginning of the period, what are the changes that has happened during the period, and the closing balance of the defined benefit obligation. So typically such disclosures are required to see what is the provision created at the beginning of the year, how much of that has been utilized or has been reversed in case of adjustments during the financial period, and how much more provision is done to arrive at the closing balance. Such disclosures are required to give information as to the movement of the balances. Then once you give such disclosures, you will also have to mention whether what type of obligations are these, what type of expected reimbursements are there. That means if you expect, okay, I created a liability or I created a provision, but if I'm expecting some reimbursement, some refund on account of this, in that case you may have to disclose what is the expected reimbursement or refund in case of such provisioning that has been carried out. Similarly, where there is contingent liabilities, very, very important here that the description of the contingent liability should be given, and where it is not possible to quantify, the reasons for why it cannot be quantified should also be given. But here one caveat. FRRB again comes into the picture and has reviewed a lot of audit reports. Whereas in the audit report, you have clause 9 currently, which talks about statutory dues, whether it has been remitted in time, right? There are 2-3 things involved in it. One particular clause requires you to disclose or report on any disputed liabilities, any disputed statutory dues. Such disputed statutory dues in CARO should be tied back to the schedule of contingent liability, because there also you are talking about disputes. There also amounts are given, but you have to ensure that these two are matching, or if it is not matching for any specific reason, you will still have to have a reconciliation in your work paper. Now, for example, there is a tax dispute that is happening. There's an amount which is paid in protest, right? But in your CARO requirements, you are only going to mention what is the disputed amount. Whereas in contingent liability, you are going to disclose contingent liability, and you will also narrate as to so much of amount has also been paid in protest, etc. So to ensure that there is sync between these two schedules or these two information, it is required for the statutory auditors to ensure that what is given in contingent liability and what is given in CARO better to be reconciled and kept as a what do you call it, as a work paper. That is very, very important. One very important aspect here in AS 29 when compared to Ind AS 37 is the concept of constructive obligations. AS 29 does not mention or does not cover constructive obligations. AS 29 covers only legal/statutory obligations, right, or contractual obligations. That means which are evidenced by an agreement or which is enforced by law. Now, what are constructive obligations? Now, constructive obligations are those obligations which the company would have promised or are been doing it over a period of time, which has created sort of what do you call expectation in the minds of the people that there is no reason why this entity will not do the act again. I'll give you one example. Say an entity, this typically happens in one industry that I can give example is sugar industry. Typically in sugar industry, there is this minimum support price that the government will decide, which has to be paid by any sugarcane procurement company or entity. But as a practice, there are certain entities which pay a little bit more than the minimum support price or the regulated price. Say, for example, the cost of 1 ton of sugarcane is say 2,700. Last year it was 2,500. Historically, they have been paying 100 rupees or 200 rupees more to the farmers only to ensure that their flock is all belonging to them. They don't go away, and there's an incentive for them to pay this additional amount. When this additional amount is being paid over a period of time, there is no reason for to believe why it should not be paid in future, because you have already created sort of an impression in the minds of the people or the vendors that an additional amount will have to be paid. That is one of the example of constructive obligation. The second example I can give is, say a company is hiving off a particular unit, and they have mentioned that because of this hiving off, it is only mentioned, say, in their website or in an, what do you call it, in a formal discussion, it has been given to understand that the employees will be given certain amount as what do you call as severance pay or certain allowance to, something like to pay in advance for them to leave the organization. Though there is no contractual obligation with the employee, it is called as a constructive obligation. Similarly for CSR activities, but then CSR provisions are quite different, where you have been donating certain things to a particular school or to a particular charitable institution. You are doing certain activities. There's a reasonable expectation that you are going to carry it out in the future. That is called as constructive obligation. It is typically very difficult to even to find it out and understand and make the accounting, but having said that, that is the requirement under Ind AS 37, where even the constructive obligations would also have to be provided for in the books of accounts. So that is a very, very big difference between AS 29 and Ind AS 37. Now, coming to the other technical lighter aspects as to what do we understand by probable outflow of resources. Now, here, if you see the word probable, the interpretation of probable, the institute says in this standard is more likely than not. And the same word probable need not mean the same thing in others accounting standard. So it is very important for us to understand that the word probable and the meaning attached to the word probable is quite different in accounting standard 29 rather than in any other accounting standard which uses the same word. Similarly, more likely than not is again some of the phrases being used in other accounting standards. So that's about probable. What is outflow of resources? Outflow of resources is the company is losing some resources, the entity is losing something in return for certain assets. Embodying economic benefits. So when there's embodying economic benefits, as I said, it necessarily does not mean cash flow. It could be issue of shares, it could be issue of any other instruments, it could be in exchange of asset, it can be anything wherever the economic benefits or resources would have to be lost by the entity which is accounting for that provision. Now, where it is not probable that it is not going to be a provision, then it goes to be a contingent liability. When it is a contingent liability, the possibility of the economic resources embodying economic benefits, whatever they call it, is remote, or the chances are very less. Or it may happen, it may not happen, depending on various factors. So this is very, very important to understand that the word probable used in accounting standard is quite different in AS 29 when compared to others. We already have a question. It says, in case of non-disclosure, can a company take a stand as it was not possible to even make an estimate of the probable outcome? No disclosure was made. No, I don't think so. You still have to make a disclosure saying that what are the efforts that the management did, but they are unable to quantify that amount. That is possible. But not giving disclosure would again lead to possibly the financial statement itself becoming or rendering itself to be materially misstated. So when you make certain assertions in the financial statements, and if the management is unable to make such estimates, that has to be disclosed. If you look at any of the significant accounting policies or even the introduction, you will always find a paragraph which says that there are certain transactions which have been accounted based on certain management estimates. Such management estimates may or may not be materially, fructify when it goes in the future. As and when something happens in the future, this will be trued up. Similar language you will find in almost all the financial statements, because nobody can guarantee and say this estimate is correct. That is why it is called estimate. But if that estimate cannot be quantified, it has to be disclosed separately. Please give examples of our understanding. Typically cases, as I said, is litigation cases or disputes cases where you will not be able to quantify what could have been the amount. For example, Nestle is a company, right? Maggie was banned. Some penalties, they are sure that certain penalties will be imposed, but they don't know how much penalty will be imposed, right? Similarly, pollution control norms have been violated. They know there will be a penalty imposed, but they still don't know on the date of preparing the financial statements what could be the penalty imposed. In those cases, yes, there could be some legal advisory and all that which could give some estimate, but if it is a position where they are unable to quantify, then it can only be disclosed. What is the best estimate? As I said, the best estimate is the amount recognized as a provision should be the best estimate of the expenditure required to settle the obligation, and such provision should not be discounted to its present value. Whenever they are making an estimate of this provision, we need to ensure that the provision is disclosed at a gross and it is not given at the discounted value, except where the accounting standard itself requires you to do. For, as I said, for example, in actuarial valuation, for example, in decommissioning liabilities, where the accounting standard specifically requires you to discount under accounting standard 29, such provisions or provisions should not be discounted to present value. Whereas it is completely the other way around, and in Ind AS 37, where all the long-term provisions will necessarily have to be discounted to present value. It has to be fair valued. And the difference between the present value and going forward, what is the next year's present value, will be treated as interest cost. That is how the accounting happens, either for decommissioning liability or for matter in under Ind AS 37 for any other long-term provision. Having said that, just would also like to add a point that if you look at the actuarial valuation report, there are three components in it. One is the current cost, one is the interest cost, one is the actuarial gains or losses. We normally don't try to understand why these three are, and we just account for it as employee benefits. Whereas under Ind AS, it is quite different. The current cost, which relates to the impact of the current salary levels, etc., which will affect the liability or the provisioning, will be accounted as employee benefits. Actuarial gains or losses arising out of assumptions that the actuary makes is taken in other comprehensive income. And interest component, which is arising on time value of money, is always taken in borrowing cost. Therefore, the same entry what you have to pass in AS is very different from the entry that you would pass in Ind AS. So this is one typical example. What is a future event? When we talk about future, how long can the future be? Is it 1 year? Is it 2 years? Is it beyond 1 year? Whenever we talk about future, typically we go back and check the same concept which we call it as going concern. Whether it's a going concern is there for next 1 year based on the assumptions that of balance sheet is normally prepared. But here, the future could be different, could be more than 1 year. It says about what could be your visibility, what could be your foreseeable chances of these expenses actually being incurred. It could be because on account of different contractual milestones that you may have, or as I already discussed in Ind AS 12, where a company is disclosing when the deferred tax asset is going to be nullified over a period of time. It is purely on the visibility that the entity can give on certain transaction. Now, expected future events may be particularly required only for the sake of provisioning. And as the standard says, for example, an enterprise may believe that the cost of cleaning up a site at the end of its life will be reduced by future changes in technology, etc. But the amount recognized reflects a reasonable expectation of technically qualified or objective observers, etc., to get an evidence to see what could be the cost, and if at all there's a reduction in the cost, what could be its implications. Having said that, there are a lot of future events that could determine your provisioning. So all that the standard says is, before you make such provision, you should be in a reasonably good position to anticipate, is there any possibility that this amount could be reduced or could be increased going forward, and how you should account for it accordingly. It could be changes in regulations, it could be change in technology, it could be change in any other factors, which is one of the very important aspects to be considered while creating a contingent liability or while creating a contingent provision. But having said that, if you are unable to know when will that future event happen, if at all it will happen, what could be the amount, obviously you will go and take shelter under it as a contingent liability, and only disclose that. But if it is a contingent asset, we would not be disclosing that in accounting standard 29. But for Ind AS 37, such contingent assets are also expected to be disclosed. Having said that, many companies still don't disclose it, but that's another matter. What is required in the standard is more important. The other factor that will get involved is when you're calculating this probability, whether this event can happen, cannot happen, or is it a remote chance it will happen. You could also take certain mathematical models, or rather make calculation to see what is the probability of this outcome. Typically, if you talk to anybody, they'll say 50-50, it can happen or it cannot happen. No, if you ask them, how do you say it is 50-50? There is no mathematical calculation behind it, but it is just an estimate done by an expert or by their experience. However, here in the AS 29, if you read the last sentence, it says, if the projected cost of a particularly adverse outcome, if there is an adverse outcome is estimated on a prudent basis, that outcome is not then deliberately treated as more probable than is realistic the case. That means you find that when you are calculating a contingent liability, there is an adverse situation, you may end up trying to pay the money or lose the resource. But just because there is an event that can happen and the event indicates that there's an loss, you cannot push it back and make a provision. Therefore, that is the reason it says care is needed to avoid duplicating adjustment for risk and uncertainty with consequent overstatement of a provision. You should tread in a very careful manner not to fall in a case where you're supposed to provide but you're shown it as contingent liability, or whether you're supposed to show it as contingent liability but you ended up making a provision which may not be required. Typically, in the auditing world, or in some scenarios, we call certain provisions as cookie jar provisions. What is cookie jar provisions? Certain entities keep making certain provisions over a period of time, and when it is actually they need, where the expenses have increased and the loss has increased, suddenly they will take these provisions and write it back to the P&L account, saying that provision no longer required, and try to manage that P&L. So that is called as cookie jar provisions. So they will be keeping certain provisions, maybe like, sort of a secret reserve or something like that, wherein it will be very difficult for the stakeholders to really know whether these provisions are actually required or they have just made it up. That is where the standards of auditing on estimating the fair value, understanding the work of an expert, looking at the management estimates, etc., comes into the picture, where now it is the role of the auditor to judge whether it is a required provision or it is a contingent liability treated as provision, or vice versa. This is a very, very gray area. In many times, if the entity comes to know that if they make a provision, obviously the profit will be lower, they ended up showing it as a contingent liability, or the other way around is also possible in few cases to window dress the financial statements. So very, very important to understand and distinguish between what is a provision, what is a contingent liability, and what is a contingent asset. Future event is something which we have already discussed. Reimbursements, again, where some of this expenditure required to settle a provision is going to be reimbursed by another party. What could be the cases? Say, for example, a company has taken an insurance policy for its gratuity benefits, right? It has made a provision. Having said that, the insurance policy is going to reimburse the company. In such cases, the reimbursement should be recognized when and only when it is virtually certain. Now, the concept of virtually certain in AS 22 is quite different from AS 29. When it is virtually certain that it is going to receive. Why? It is an income. Normally, we recognize income only on a very conservative basis. We take it only when there is an absolute surety that this amount is going to be realized. Only then we account for it. The reimbursement should be treated as a separate asset for a moment, and then such amount should be recognized for the reimbursement, but that should not exceed the amount of provision. That is something which needs to be taken care of. In the statement of profit and loss, it is essential that the disclosures relating to that amount is also given. In the statement of profit and loss, the expense relating to a provision has to be shown separately, and typically we write this is a provision less amount expected to be reimbursed, and then give the net amount. Don't give the net amount directly. There has to be certain disclosures for that. The other concept here is on restructuring cost. What are restructuring cost? Restructuring is when the entity has to sell or terminate a line of business. It is closing down a business location. It is closing down its activities, or there's a change in management structure and they would have to pay a certain level like VRS obligations, etc. There is a fundamental change in the business model. There is a fundamental change in the business itself. And such a change could have a very significant impact even on the prospects of the company, of the entity, or on the entity's operations. In those cases, a provision for restructuring cost is recognized only when certain recognition criteria. What is the recognition criteria? You will have to go back and see whether there is a provision required or a liability requirement. Only then you will have to account for such restructuring cost. No obligation arises for the sale of an operation until the enterprise is committed to the sale, that there is a binding sale agreement. This is again going back to the same concept, that whenever there's an income, we take it only when we are absolutely sure that it is going to be realized and not before that. Whereas for expense, we try to accrue it as and when it occurs. The same substance over form and the same fundamental principles are getting reflected in more ways than one in different accounting standards. This I have already covered in my earlier discussions. Discussion on discounting of provisions not permitted under AS 29 except where the standard permits it, whereas under Ind AS 37, long-term provisions have to be discounted and accounted for. The difference is treated as interest cost. In AS 29, you would be covering only legal and statutory obligations, whereas under Ind AS 37, you would also cover constructive obligations. Recognition of contingent assets, AS 29 is very strict. You can't even recognize it, not even disclose it, whereas Ind AS 37 permits only disclosure and not accounting for it. What are the typical mistakes that we see from the FRRP point of view? As I said, certain provision has been included in liability or liability has been included in the provision, which could change the value of the schedules, may not change the value in the balance sheet, but then it's an incorrect disclosure. which has to be taken care of, which has to be rectified. Then FRRB has also commented in some company where the provision for sales returns have not been made. Historically, if there is always sales return, there is no reason to believe that why there should not be sales return unless there is a dramatic change in the way the business operates. And if you even look at the post balance sheet also, there will be certain sales returns. Such sales returns should also be provided for under AS 29. When you provide for what could happen, see, typically in a sales transaction, a sale bill is raised. If under AS 9, if that revenue should not be recognized, you reverse the sales, continue to show it as a stock. But what happens in case of sales returns, the sales is already recognized, but there is a possibility that the customer may have to return back. Now, if you look at the trend analysis, it appears that after 2 months, after 1.5 months, 10% or 7% of the sales are returned. Then in such case, for such amount, a calculation has to be made, an estimate has to be made, and the provision has to be created for the sales returns as well. Now, the third aspect is export obligations, which is, I'm sure, will be there in many entities, where the entity would give an undertaking to the government that they will be exporting certain value because they would have also imported certain assets, certain materials without paying the duty. They would have taken duty concession with the condition that the whatever is the items that they have imported, they will do some manufacturing activity and they are going to export it. When they have to export it, the government would have given certain guidelines. Within so much of time you should export, within so much of value it should be export. But as of 31st March, if the company has taken certain benefits and it has not yet fulfilled its obligations, obviously there has to be a note coming into the financial statements as to what is the estimated obligation that they may end up losing or end up paying to the government for not doing the exports or not fulfilling its obligations. This is something which FRRB found that many of the entities were not providing for or were not disclosing. Again, another example is accounting policy mentioning about certain estimate instead of reliable estimate. I also happen to recall the first day session where Mr. Gururaj Acharya also clearly mentioned that you cannot use any language other than what is typically used in the accounting standard. Accounting standard says reliable estimate, it is reliable estimate. We cannot mess around with the words and tune it to the requirements, which could definitely convey a completely different meaning. So you cannot use the word certain estimate. Then liabilities will be paid as and when claimed, which indicates that the probability of outflow of resources still exists. Having said that, liabilities will be paid as and when claimed becomes cash system of accounting. It is not accrual system of accounting. Many of the members here may recall that even when AS 15 was made mandatory, many of the companies had this pay-as-you-go concept. As and when the leave encashment was given, only then it was accounted. But such concepts are no longer permitted. It has to be done on accrual basis. Hence, any liability, whether it is being paid or not being paid, is the different question. It could be settled in other means, but it has to be accounted for. Hence, writing back of the provision, even when there is a writing back of the provision and taking it to income, like as I said, it could be a cookie jar adjustment where you just keep creating provisions or small provisions under different heads. For example, communication expenses, printing expenses, like this, you keep creating some provision and you know very well that this is not actually going to fructify, then you write it back on one fine day and boost the profit. That is not definitely allowed. It is what FRRB also indicates. Then, if there is a reason that the contingent liability cannot be quantified, then we have to be very explicit saying that why it cannot be quantified. Then is it was noted, this is something which I need to read and then explain. It was noted that the reproduced abstract of Caro report that the company had given. Now in Caro report, if you see, there are a lot of clauses. One of the clauses would say is whether the company has given any guarantee or what has happened to it. If there are certain cases, you will also have to, though it may not relate to non-company, Caro is not applicable to a company, but for academic interest, I'm saying, where the auditor is mentioning that there are certain guarantees given, etc., please look on the other side of the balance sheet, what is there. Similarly, as on the balance sheet date, the bank/financial institutions had claimed a huge liability, including interest against those guarantees, which the company had not acknowledged it as a debt. In those cases also, it's an issue. Now, in this typical case, what has happened? A company has been taken over. When the company has been taken over, they have not disclosed certain liabilities. They have not disclosed certain hidden issues, which has created a bigger issue to the company which has acquired it. All the more important is when they account for certain provisions or account or disclose certain contingent assets, contingent liabilities, it could even trigger a going concern issue also. That becomes a bigger one when the financial statements cannot be prepared under historical cost basis, possibly then it has to prepare under liquidation basis. The other FRRB point, it's a very good point that they found in many of the reports are guarantees given against the own performance of the company does not give rise to any contingent liability, because the company in case holds an obligation to perform the event against such guarantee. For example, I am running a company, I am running an entity. The banker has given me a condition that only if I guarantee, right, about a particular performance, then such guaranteeing against our own performance is not a contingent liability, because contingent liability will is because of an external factor happening or not happening where we have very little control. So it is very important to, again, very important to assess whether it is a financial guarantee or it's a mere performance guarantee. There's a difference between the two. In case of a financial guarantee, you are guaranteeing to a person that if, say, X is not paying, then instead of X, I'll be liable, I'm sure to pay. It becomes a financial guarantee. But the performance guarantee is where you're trying to convince, trying to promise the other person that I'm going to do a certain level of activity as agreed upon, which is typically under my control. Again, when it comes to financial guarantees, under AS 29, we don't account for it. We only disclose it in the financial statements that there are certain financial guarantees. Whereas in Ind AS 37 and read with other standards on financial instrument, such financial guarantees will have to be accounted for. Disclosure is not sufficient. You will have to account for such financial guarantees also as a liability. Now, how are they going to account for a financial guarantee? Say an entity has given a loan to its subsidiary at 10%. If that entity which has taken the loan goes to the bank without having the guarantee, it may end up paying 14%. Now, such differential amount is treated as possible value of the guarantee that needs to be accounted. Or if the company or an entity has taken a loan based on certain credit rating, and this credit rating would have literally gone down if such guarantees are not there, then the possible impact on the cost of raising funds needs to be recognized as a liability and then accounted it over a period of time. If none of these are available, at least what could have been the cost to have this guarantee, such cost would also have to be accounted for. And the company which gives the guarantee should reevaluate at every reporting period and start providing for it if it is required. Of course, it's a separate topic completely under financial instruments as to how to account for financial guarantee. But for this discussion, suffice to understand that financial guarantees under accounting standards are only disclosed, whereas financial guarantees under, Ind AS will have to be accounted for. Now, as I said, why I keep talking about Ind AS, as I gave the example, there is a possibility it's a non-company entity, but it may have to account for certain Ind AS, or it has to prepare Ind AS financial statements, at least for the purpose of consolidation. That's the reason I keep giving the differences between the two standards. And again, one more area that we need to touch upon is ICDS. Again, as I said, there are multiple accounting standards or compliance standards. ICDS 10 typically talks only about reasonably certain, the word that is used to recognize a provision, to recognize a contingent asset or disclose it for that matter, or reversal of provisions. They always use the word reasonably certain, whereas in AS 29, the word used is probable. Under AS 29, the word probable has been defined, whereas reasonably certain may seem to convey the same meaning, but as I said, the words could be different, the meaning could be different, and there could be cases where you may make certain provisions under AS 29, but it may not be allowed under ICDS. Again, there could be difference in that, which could lead to the first session that we had on deferred tax asset or liability, as the case may be. So this is the presentation that I had so far, and I would be more than happy to take any questions. Mr. Shetty, any questions? Divya, any questions that you see on the chat box? Any questions? Am I audible? Shetty sir, am I audible? Yeah, but I'm not sure whether Divya and Shetty sir are able to listen. Thanks, Mr. Jayant. You're saying that you are audible. Any questions that you have?
So you're audible, sir.
Divya, the topic of both AS 22 and 29 I have covered now. I'll be happy to take any questions that the audience may have, or any clarifications that they may need, or to revisit some of the topics that I have covered in the last 2 hours, 15 minutes.
So
the topics are less, it cannot be done for 3 hours. So at best, I have covered all of them. And as I said, many of these may not be applicable for non-company entities.
Mm-hmm. So there's one question, sir.
Sure.
In case of non-disclosure, can company take a stand that as it was not possible to even make an estimate of the probable outcome, no disclosure was made?
See, here what happens, Divya, is my personal view is if you don't disclose it, it is going to end up going to be a surprise somewhere down the line. And such surprises could really affect the financial statements and, the investors or the stakeholders, however it is. That's the reason the standard says is you at least disclose that there is such a transaction, but you are not able to quantify that for some reason. That will at least put a red flag, or at least alarm the investors or the stakeholders. Okay, there is some transaction, there could be something in store which we don't know how much its value is.
Okay. There's one more question, sir. Please give a few examples of those events which fall under can offset DTA or DTL if the tax law permits.
Yes, I had answered this question.
This question is
Just to
answered.
repeat, for example, your capital gains chapter allows you to offset certain things against business or other sources. It may not be so in other countries or in other provisions. Then you cannot offset your DTA or DTL. It has to be shown separately. I'll give you one more example. Say the income tax rate for short-term capital gains or the capital gains is quite different from the tax rate which is otherwise used. Can it be offset? It can be offset because you're paying ultimately the tax as one amount. You're not paying the taxes differently. But where you cannot offset these two, then you cannot show it separately. And one more area that I thought I should also cover is we have covered the P&L account, we have covered the balance sheet and the disclosures. One very important area is also the cash flow statement, wherein the income taxes paid should be shown as a separate line item. The differences between deferred tax asset and income should not come in the cash flow statement. It is only the actual cash outflow that is arising out of tax payment will come in cash flow statement.
Okay, sir. So one more question regarding timing difference. Was that answered, sir?
If you could just repeat it.
I'll repeat the question. In a situation where there is no variation in the amount of timing difference, but there is only reduction in the income tax rate, should the carry forward? Yeah.
Yes, I have answered this, but I'll just answer it again. Say you have already calculated this is your deferred tax position. While preparing the financial statements, the substantially enacted law in the next year has reduced your taxes. Typically, this has happened couple of last year, I think, when the tax rates were reduced. So when the tax rates gets reduced, you would be taking only the revised tax rates.
Okay. Only these many questions, sir. Hello?
Yes.
Yes, sir. Only these many questions, sir. Yeah.
Yeah, if there are no other questions, with the permission of the chair and others, possibly we can bring this to a close.
Okay, great, sir. Thank you so much, sir. On behalf of Bangalore branch and also on behalf of entire participants, I take this opportunity to thank you so much for spending your valuable time and giving an excellent presentation. It was really delighted to have you here, sir. Thank you so much once again.
Divya, I just have two things to communicate to all the delegates. One, I'm sorry, it was delayed because of some technical issue from my side. And the second part is, I'd be happy to take some feedback, including that maybe if I have to spend 3 hours, but then I tried my best. This is a topic which can be at best be covered. And there's no point in going on and on, without really value adding anything. So I thought I'll restrict it to whatever is required for this particular session.
No issue, sir. Absolutely no issue, sir. We understand. No issue, sir. Thank you so much, sir. Once again, on behalf of all of us, we would like to have your physical presence for some of our physical sessions, which will be starting shortly.
Sure. I'll be more than happy to, take it.
Thank you, sir. Thank you so much, sir. Dear participants, thank you all of you for active participation. Request all of you to kindly visit Bangalore branch website for further programs. Thank you. Thank you, sir.